reason consumers are unhappy is fear of inflation. What we learned in 2022, consumer sentiment dropped, but they kept spending. That's because people basically hate inflation. It's unfair, uncertainty, feels like you're not getting appropriately rewarded. They just hate it. That doesn't mean they stop spending. They're just unhappy about it.
Welcome, everyone. I'm Gunjan Banerji, and this is a special bonus episode of WSJ's Take on the Week. Today, we are going to dive into the question on everyone's minds right now, which is, when will the Federal Reserve cut interest rates? We have the perfect person to chat with today, and that is Tom Barkin, president of the Richmond Fed. Tom, thank you for joining us today.
I'm looking forward to it.
So I want to dive right into the news because my colleagues here at the Wall Street Journal, Brian Schwartz and Nick Timrose, recently reported that President Trump is considering announcing and naming Fed Chair Powell's successor as early as this summer. What did you think of that, and what would that mean for monetary policy if that announcement were to be made sooner than expected?
Well, the first thing I thought is, I wish I didn't have to go to the Wall Street Journal podcast and talk about it. No, I don't know what the president will or won't do. I'll just say that, we're in the business as the Federal Reserve of, trying to make the best monetary policy we can. And certainly my theory of the case is I'll listen to anybody. And, there's lots of people in the media and in Wall Street who have different points of view on what we ought to do. And, I like listening to folks. Sometimes I learn. Sometimes I have a different point of view. And I'll behave based on what I think is the best thing for the economy. And that's what I just always do. So
it seems like we're at such an interesting moment for the Fed, where a lot of people want the Fed to start trimming interest rates, including our president. What would it mean for monetary policy in terms of this announcement? Let's say if the financial markets, if investors, in anticipation of a new Fed chair, start pricing that into, say the bond market, what would that mean for monetary policy, and how would you view those clues from the financial markets?
Well, we do our best to telegraph what we think we're going to do, in the world of high uncertainty that we live in. And financial markets behave accordingly. It's not always the case that financial markets are in the same place that we are. If you look at the last 2 or 3 years, in fact, for most of the time, there's been a meaningful divergence between the average financial market forecast and the median of the S&P. They tend to converge in time. If you look at the fall of 2023, the number of rate cuts people projected for 2024 versus what the median S&P was, they were wildly different. By the end of 2024, they were about the same. So, these things work their way over time. I guess I'll just say the president will name a new Fed chair. I mean, Jay's term ends, I think, in May. And so I don't think there's a lot of news for the markets that there's going to be another chair. We'll see who he names and when he names them, and we'll just do our best to keep our eyes on the road.
Yeah, and to your point, investors have kind of gotten this repeatedly wrong over the past few years.
Well, I guess I just come back to the fundamentals, which is that economic forecasting is really hard. And it's really hard because the economy is huge and multi-dynamic, and people have very different views on how things are going to play out. It's hard because exogenous factors always show up. And so, I don't put that much weight on people's forecasts 3 or 6 or 12 months from now. I like to say, let the economy do its business, and then the right policy will be pretty straightforward as we learn more about the economy. And that's worked very well for me.
Economic forecasting seems incredibly hard. I'm thinking of the past few years when it seemed like every investor I was chatting with was banking on a recession or thought that we would see a recession, and we kind of headed toward a soft landing. Is it harder than usual right now, given everything going on?
I think it's always hard. And, I've done this job for 7.5 years. So during that period, we had, the tax cuts in 2017, and a lot of people had forecasts about that. And they'd had the tariffs in 2018 and 19. You had COVID. Obviously, you had an inflation surge. You had a big set of rate increases. The one thing that is consistent through that is people have been predicting recession all the way through.
Right.
And if you predict it long enough, it will happen. I mean, no one canceled the business cycle. So we'll see.
Right. And then those people can claim victory when and if it does happen.
Well, an interesting predictor is the yield curve. And people say when the yield curve inverts, then you're going to have a recession.
Right.
And that's happened, I think, 6 of the 7 times that the yield curve has inverted, during the last 40 or 50 years. What's interesting is to go back and look at those cases. So like one of those cases was COVID. I'm not sure the yield curve predicted a pandemic, but you could argue that. In one of them, it happened 3 or 4 years afterwards. So I think that was in the 90s. So I just say be careful of these sort of indicators and predictors. In our working lifetimes, the recessions we've had have all come from left field. Lehman Brothers was left field. The pandemic was left field. 9/11 was left field. The Iraq War was left field. I mean, maybe Paul Volcker is the last one that came because the Fed did something. And so there haven't been that many recessions that have been predicted by all these indicators. They've all happened and driven by things that weren't predicted. And so, again, you got to play it out and see where it goes and then make the best policy you can as appropriate.
So you've said you don't think the Federal Reserve should be in a rush to cut interest rates. Why is that?
So I've been describing today's economy as like driving through fog. Just some examples. There's a tax bill being discussed, but no one actually knows what's going to end up in it and when it's going to pass. We've talked about tariffs, but I don't know. Maybe you know better than I do, but I couldn't tell you what the tariff rate on Europe is going to be 6 months from now.
Sure.
So there's a lot of uncertainty out there. And when you drive through fog, and this is true for the businesses I talk to, and I'd say it's equally true for the Fed, there are a couple things you don't want to do. You don't want to put your foot on the gas, because if you put your foot on the gas, you don't know what lies around the next curve. You don't want to put your foot on the brake because you don't know, who's going to run into you. And so, often drivers in really dense fog pull over and put on the hazards, wait it out. That's what the businesses I'm talking to are telling me. They're not cutting back. They're not putting their foot on the brake. They're not laying a lot of people off. But they're also not leaning into things like hiring and investment. They're just waiting for the fog to clear and see where we go.
They're just holding steady.
Right. And for us, I could describe to you an environment that's going to be inflationary, tariffs and the like. I could describe for you an environment that's going to be contractionary. I could describe to you an environment that's going to be neither of those two. And I'm just not sure I'm in a rush to decide and then wake up and figure out that the fog lifted and we're actually headed down a different road.
What does that mean for the economy if businesses are kind of just playing it safe, holding steady, not making any big decisions either way, if that's what you're hearing from them?
If it's a short-term thing, it's not a big issue. We'll get through it. But if that's true for the long term, if people think that volatility is elevated for the long term, that'll be a challenge for hiring and investment.
And I'm curious, do you think there's a shift between how consumers, or do you think there's a divergence between how consumers are behaving and how businesses are behaving right now? Because what you're saying about kind of holding steady, playing it safe, there's been a fall in consumer confidence, but not really a huge drop in spending.
So I've been looking at that hard. And certainly 3 months ago, when you saw the big increases in business uncertainty, consumer uncertainty. But what we're seeing on the business side is what I described. On the consumer side, spending continues. And so I do not hear that consumers are pulling back. Again, this is not 2022. It's not frothy. But consumers continue to spend. And I've talked to some of the biggest retailers, and they say very solid nominal consumption growth year over year, very solid. Credit card spending, which I watch every week, continues to be up year over year. And so despite what you see in the sentiment, consumers are spending. And I think the issue there is the link between consumer sentiment measures and consumer spending is not high when the reason consumers are unhappy is fear of inflation. What we learned in 2022, consumer sentiment dropped, but they kept spending. That's because people basically hate inflation. It's unfair, uncertainty, feels like you're not getting appropriately rewarded. They just hate it. That doesn't mean they stop spending. They're just unhappy about it. And with all this tariff news, that's the same thing you hear from consumers, which is my prices are going to go up and I don't like it. Prices haven't gone up yet, but they're worried about the future, and that's what they're worried about.
So you pay more attention to that hard data on spending than the sentiment data?
I pay a lot of attention to the hard data on spending, and then I spend a lot of time doing deep interviews with consumer products manufacturers and retailers to understand what they're seeing in terms of price elasticity. And they're telling me they see it. They see consumers trading down.
Do you think the link between sentiment and spending is broken?
I just think there's certain types of sentiment that don't lead to the same insight on spending. And when you're in a high inflationary environment, I think the sentiment indicators just mean something different.
We're going to take a quick break, and when we get back, we'll dive into tariffs. President Barkin, I have a hypothesis that I would love to get your thoughts on, because I think consumer sentiment is heavily influenced by Americans' social media use. I think social media can, drive a lot of FOMO. I think it can make some people depressed. And I wonder if that's what's led to this really dour sentiment we've seen the past few years.
Well, no question, we're in an always-on media environment. My little metric is my phone. Whenever I pick it up, I get 15 notifications on the news of the day. And if the news of the day is tariffs, it's tariff, 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 tariff. And I think people react to that. And I believe that one of the reasons you're seeing elevated inflation expectations coming out of news about tariffs is because of the omnipresence of that kind of media communication. And then think about it. The pandemic. It was just going to be a cold on Tuesday, and then we'd shut the entire economy down on Thursday. Think about inflation. When that hit in 2021 and 2022, you couldn't escape it. It was in every piece of social media and every piece of online that you saw. And I just think that in today's environment, the news travels faster and people get convinced of stuff a whole lot faster than they ever were before. And I think that's playing a part in people's expectations today.
And sentiment.
Absolutely.
That's so interesting. Yeah, it does make me wonder if that link is broken a little bit.
Well, so you always have to take these signals and take a step back and say, what are we learning today versus, what you might have thought you were learning. It's the sunspot theory. You can always look backwards and say, see, when the sunspots came, it turned into recession, or when the AFC team won a Super Bowl, that meant something. But the past doesn't always predict the future. And so you do have to think about whether the circumstances have changed. And on consumer sentiment, and it's linked to consumer spending, that's where I see the change.
So let's talk about tariffs. A lot of investors I've been chatting with have been surprised that we have not seen the effects of higher tariffs in some of the hard economic data yet. When could we start to see that?
I think you'll start to see it this summer. Two conversations I've had recently that have really influenced me are with big national retailers. And I've asked them, what were your price increases in May? And they said, basically flat, which is what we've seen in the CPI. And I said, well, why aren't we seeing the impact of tariffs on your prices? And they said, well, because the stuff we sold in May is the stuff we bought in February. And in February, we didn't have significant tariffs. And we're not dying to pass on prices to a consumer who's exhausted by price increases. We're trying to keep prices low. We will pass it on, when the costs go up. But the cost really only went up for us, they'll say, in April, where they didn't take that many goods because of the huge tariffs on China. And in May, where now they're taking 30% good price on China and 10% everybody else. And so those May costs, they're going to come through in August. I talked to a different retailer who said, we haven't raised prices yet, but we're doing a reset in August, and we're going to reset our price labels, right, from one price to another on a rolling basis through August. So it takes time for cost to work its way through inventories to prices. 3-4 months is a pretty reasonable way to think about it. Manufacturers and retailers are doing everything they can not to pass it on because they're not dying to meet an exhausted consumer. But, it will hit in July, in August, and September. Now, just because someone raised prices doesn't mean you see inflation, because you've still got an exhausted consumer on the other side who may or may not accept those prices. And so what I've been saying sort of snarkily is it's kind of a cage match between a emboldened retailer and an exhausted consumer. And we'll see if those price increases stick. And we'll see if they do stick, whether consumers take volume out of other parts, because there's no new income coming into the consumer's pocket to pay for it. And so the net of that is whether we'll see inflation or not.
Fed Chair Powell, in his recent post-meeting press conference, kind of highlighted some of the complexity around who pays for the tariffs, right? Is it the consumer? Is it the manufacturer, the importer? Who pays?
There is a big chain, and it depends on the product. It depends on where your competitors source those goods from. Is it the same country or is it different countries? Importantly, it depends on what the tariff rates are going to be, because we don't even know that at this point. But some of it will be caught in exchange rate movements. Some of it will be caught in manufacturers eating it. Some will be caught with wholesalers or retailers, and some will go to the consumer. I think that's all of the above is true. And what you see right now is an extended supply chain negotiation between all of those players. And that's part of the reason why you haven't seen it show up in prices yet, because your retailer is saying, well, we got to negotiate that out. I'm not just taking it. Let's take a month or two and work it out. That's also part of what's happening.
There just seems to be so much uncertainty out there, right, about tariffs. To your point, maybe we see them this summer. Maybe they take some time to go into effect. And yet when I look at, the stock market, it's near a record. When I look at the bond market, high yield bond spreads, these are some of the riskiest bonds out there. They're not showing a lot of concern out there about a recession, about tariffs, about anything really. What do you make of that? And is that a signal that you follow?
If I really understood the markets, I'd be in a different profession. But look, consumer spending is 70% of the economy. And I guess I would just focus you on the health of the consumer. I've said they're exhausted about price increases, and they are. But they're still spending. And the reason they're still spending is consumers have jobs, unemployment's very low. Real wages have been up, not down. I mean, you're seeing comp increases in the 4% range and inflation in the 2% range. And asset values are still elevated. And so wealthy people have money and they can spend. And so you may not like that your Diet Coke is more expensive, but you're still spending money on the things you're spending money on. And as long as that goes, it's going to be very unlikely we're going to see a recession. And so that's probably, what you're seeing in investors' perspectives. Now, that could change. It could change, as I suggested earlier, with something winging in from left field. And it could change if you start seeing a round of layoffs that then cycles into more unemployment and therefore people cut back on spending. I guess it could also the market side of it. But all of those things could happen, but they haven't happened yet.
So you think the U.S. economy can withstand higher tariffs and won't fall into a recession?
Well, we had higher tariffs in 2018 and 2019,
Not
and
this
the
high.
economy was fine. They're higher today, but we'll see how these things play out. We'll also see how high they end up being. I mean, like I said, the fog is here, and anyone who tells you, I know what the tariff rate is going to be on a particular country X months from now, I think has got more confidence than I do. I don't see anything in the economy now that implies that it's breaking or close to breaking.
I see what you're saying. At the same time, people who have been calling for a recession the past few years have been wrong. And to your point, it is often this black swan event that no one predicted. And right now, everyone is predicting or everyone is worried about tariffs causing a recession, right? So maybe this isn't that black swan event. But the latest jobs report showed that unemployment was low, but jobs growth is slowing. My colleagues at the Wall Street Journal recently reported that the unemployment rate among recent college graduates is really high. Consumer confidence has been falling. What do you make of that patchwork of data, and how does it shape your view on the economy right now?
So first of all, big picture, the economy is very solid. And that's what I've described in terms of strong spending, low unemployment, inflation coming down. There's then a very wide and diverse policy mix that's being injected on top of that economy. We've talked about tariffs. You mentioned, less immigration, which lowers the denominator on the unemployment rate. There's a bill going through Congress that, has a bunch of stuff going in it. There's a deregulatory focus by the administration. Energy prices are another uncertainty that could go one way or the other. And the question that you try to figure out is this entire policy mix, not any one part of it, but the entire policy mix, how's that going to end up? And that's then made more complicated because I think you've got the ability to change policy, as we saw with the tariffs in China, to the extent that it doesn't look like a policy that you want to pursue. And so there's a lot of uncertainty, but I don't think anything's hit the economy yet that feels like one of these shocks from left field. I'm not saying it couldn't hit. Of course, anything could happen. You mentioned immigration. Well, job gains are coming down. But they're still at $135,000 a month, basically where they've been for the last 12 months.
Sure.
And the denominator is coming down because you have, by all accounts, fewer people coming into the country. And so you're not growing the workforce as fast as you were, and job gains are steady. That's not a breaking of the labor market.
It's just like a normal, this is what happens.
For your college graduates, I do think that's a real issue, is that it's harder and harder to get into the workforce. A big part of that is because companies are uncertain. and they've cut back on hiring. They're not firing. They've just been through the last shortage. They don't want to be caught short, but on the margin, they're not hiring. And when you talk to companies about deployment of AI and you think about the jobs that they're most likely to be experimenting with, it's the stuff that a recent college graduate does. And so AI is just an enabler of them to reduce their hiring further.
I mean, is it telling us something bigger, though? Like, how else do you think AI changes or shifts our economy in coming years?
It'll create some jobs. It'll eliminate some jobs. It'll enable some jobs. I think all of that's the case. Cybersecurity wasn't a profession 25 years ago. Now it's an enormous profession. And I don't know what the equivalent job will be, prompt writer, for AI, but there will be jobs out there that we haven't even thought of today that will be relevant.
What would it take to clear this fog that you mentioned?
Well, there's two ways this happens. One is a lot more policy certainty. And there are vehicles for that policy certainty right in front of us. Tariffs, there's a date coming up that where we may see a lot more clarity. Tax bill, there's a date coming up. We may see a lot more clarity. So I think policy certainty, that would be one element of it. The second element would be, or the second way is keep the same kind of policy uncertainty, but businesses just decide they're not going to wait anymore. If you're a business who just decides you're not going to wait anymore, basically you're saying volatility is going to be a permanent feature of this, and I'm just going to up my effective discount rate, and I'm going to make the decisions on investments or employment that I have to make in a higher uncertainty environment. And we'll see.
We are going to take one last break, and when we come back, a final question for Tom Barkin. So given everything we've just discussed about tariffs, the economy, you name it, what do you need to see in order to shift your stance on cutting interest rates?
There are a lot of ways the economy could evolve. Obviously, you could end up with a higher inflation environment that you convinced yourself was more persistent. That would move rates one way. You could end up with the employment market cracking. That would move rates the other way.
What would a crack look like?
No, you start being very concerned about what's going to happen to employment, over the coming, quarters. And then you could have a situation where you convince yourself that we're actually not going to see that much inflation and the labor market's pretty solid. And that's your classic soft landing scenario. And that would be a third model. And I think if you look at the SEP from the last meeting, you'll see evidence of all of those models in the various places, my colleagues and I put our projected rate paths. And I never sort of try to overthink a meeting that's 3 months away or 6 months away.
Sure.
Let's see where the economy goes. And I think we're very well positioned right now to react. If you feel like you have to support the employment side of the mandate, we're well positioned to act. If you have to support the inflation side of the mandate, we're well positioned to act. I think we're just well positioned for whatever comes.
Thank you so much. That's all for today, and this has been really great to have you on.
Glad to do it. Can you cut out my stupid answers too?
Or my stupid questions.
Yeah, no, you haven't asked it. Yeah.